I'm Monica Hammond. I am the founder of the Chauffeur Marketer. I've been in digital marketing for over a decade now, working with a variety of different niches. And the profit first method, just for reference, is something, it's not something that I created. It was created by a guy named Mike Michalowicz. But when I started implementing this for my businesses about 3 or 4 years ago, it helped me tremendously. So I'm really hoping that it helps you guys as well. So why don't we get started? In this training, we're going to cover a couple things. First thing is, what is the profit first method? We're going to talk about why it's useful for chauffeur transportation companies and professionals. We'll go over all the core principles of profit first and really how to implement this very specifically into your business. It's really not very challenging, but I'm going to go through the step by step and also show you how it can really, really help you assess the health of your business. Because we'll go through how to set up the whole system and then evaluate, all right, here are numbers of a healthy business where I feel like my business should be based on my revenue, and then look at where you have been over the past year and then see where that delta is and come up with some ideas on how you can improve your business. Improve meaning save more for profit and increase your owner income, decrease expenses so that you have a healthier business. Okay, so why don't we go ahead and get started? Before we dive into the whole profit first method, I just want to address a mindset that I see with business owners in many, many niches, really any industry, but I've seen in particular in the chauffeur transportation space, and it's the scarcity mindset. It is that limiting belief that there are not enough resources, there are not enough clients or customers out there, there's too much competition, there's not enough for me, right? So if you're struggling with this mindset, I encourage you to pay attention over the next couple of minutes while we talk a little bit more about it, because it is easy. Obviously, you're in a competitive market. Uber and other companies have come in and really disrupted things. COVID, it really changed the industry as well. So it's easy to get sucked into the scarcity mindset and just feel kind of like, oh, nothing's going to work. There's not enough. I feel scared, all of that. But let's talk about how we can overcome that a little bit. So, focusing on your strengths, both your strengths as an entrepreneur, as a business owner, as well as the strengths of your specific business. What is your company good at? What is your unique selling proposition, right? That's how you can set yourself apart from the competition. And then seeking out positive people and groups. It sounds simple, but for myself, like I'm always a part of a different mastermind or coaching program. I spend probably $25,000 to $50,000 a year being a part of coaching groups and masterminds for high-level entrepreneurs. I encourage you, certainly you don't need to spend that much money, but a group like this where we come together a couple times a month, and then in the community as well, anytime you need it, to be that positive sounding board, to answer questions, give advice. I encourage you in this community, like there might be people in the community who are seen as competitors. Don't see people that way. Everyone is doing their own thing. There's enough to go around. So please, I encourage you to really seek out this sort of positive environment and people who can help you. And I was so happy on our last coaching call, someone had a question about how to grow a certain part of their business, and a couple people hopped on and gave advice. So that's really what I'm looking to build here with this RideScale program. And then, of course, cultivating an abundance mindset. So just reminding yourself that there is enough. There are plenty of opportunities to go around. Success is not limited. Just because one of your competitors is succeeding doesn't mean that you're failing. And then really taking risks and overcoming that fear. For me, it was a risk for me to enter this market, for example, the chauffeur transportation industry. I was quite honestly, to be totally honest, I was warned against entering this industry, but I decided to take the risk, and I'm so happy I did. I feel like I found a lot of people here who could really use some help. For example, I've been spending over $10,000 a month in advertising to get people into this program and support the work that I'm doing. And it's already paying off, right? So sometimes you just have to take the big leap, take a risk, overcome that fear, and that can make all the difference. Okay. So, the last thing is really investing in yourself. Like I said before, when you invest in yourself, you are never going to lose. Whether that's self-help, whether that is business help, investing in a group like this or a different mastermind program, I just highly, highly recommend it. Even just reading books like this Profit First book, which I'll show you in a minute, can really make all the difference and give you that confidence and that boost to continue forward, even in the face of competition. Okay, so now that we have the mindset sort of touched on, let's talk about what is Profit First. So, Profit First is a method of cash management. It's a cash management system that aims to help businesses become more profitable by really prioritizing profit over expenses. Now, all of this sounds so simple, but we're going to get into the nitty gritty. And in its essence, it is pretty simple, but can be a radical shift depending on how you've been operating your business in the past. So it really just helps you prioritize profit above everything else. And when I implemented this system for all of my businesses, I own 5 businesses, it really gave me a lot of clarity into the true financial health of each of my businesses. And it allows me to do it without having to reach out to my accountant or my bookkeeper every time I have a question about, like, oh, can I afford to pay off that credit card in full? Can I afford to hire that new independent contractor or invest in this coaching program, right? I know because I can see it plain as day in front of me in my bank accounts, which is what we'll talk about in this entire presentation. Okay. So, Profit First, quick facts. We're going to dive into this much deeper, but the first thing is take your profit first. So, rather than waiting until the end of the year or the end of the month or the quarter to see what's left over after you've paid out all of your expenses, the Profit First method really encourages you to set aside a portion of your revenue as profit from the very beginning. So this ensures that your profit is a priority and that you're not just working to cover your expenses, which I know after talking to many, many, many people in this industry, that can be a challenge, right? I talk to guys and they don't know how much profit they're taking home. They don't know, especially if they're in the affiliate side of things, like they don't know what they're paying people out and what they have at the end of the day. That should not be happening. Okay. Profit first, quick, fast. We're going to allocate money into specific bank accounts. We're going to dive into this more, but the method really recommends dividing your revenue into different accounts based on their purpose, such as profit, taxes, owner's pay, and operating expenses. So this helps you manage your cash flow better and ensures that you do have enough money to cover your expenses, pay yourself, and pay taxes at the end of each quarter, at the end of each year, right? It's absolutely crucial. And then another quick fact is you want to implement a rhythm for this, right? You can't just be kind of willy-nilly about it. For example, every single Monday, I look at what is in my income account and then I divvy it up according to the percentages that I've set aside, which we will go over, into the rest of my accounts. And then from there, I pay myself out, I pay my team, I pay my credit cards, etc. Right? So you need a rhythm, which for me is every single Monday. You could do this monthly, depends on what your preference is. Okay, then one of the main points of this is not just to set aside profit, but to help you reduce expenses. By doing this sort of religiously every single week or every single month, it allows you to see how far you are away from actually what an ideal healthy business looks like and will help you comb through your expenses in a different way, right? Because you're going to set aside a certain percentage of your revenue for what you can spend in expenses. And if you're going way above that, then you know you have a big problem, right? That you need to figure out where you can cut different expenses. So why does this work specifically for chauffeur professionals? Well, managing cash flow is tough for people in this industry, right? Not everybody, obviously, but some people find it challenging to really get a sense of how much cash they have on hand, especially if they are facing more challenging times. So this really helps you manage that cash flow by allocating things to proper accounts. It also provides you a clear picture of your finances without too much accounting or math. I don't know about you. Way back in the day, I had a theater background, so I'm not a math person. I'd like to be able to just get a clear picture of where my finances are without having to like dive really deep into a P&L statement or reach out to my accountant or, figure anything out. So it makes it just very, very easy to see when you log into your bank, how much you have. And it can also help you create a nest egg of cash, right? There are times that are leaner. Sometimes there are businesses or locations that are seasonal. It'll help you set aside what you need to set aside to be more comfortable. And then it actually ensures that you make money from your work. You're not guessing about how much money you have, how much money you can take home every month. It's all predetermined. And then you can see how things are fluctuating and adjust accordingly. Okay, so let's talk about taking profits first. The traditional way of running a business, which may or may not be how you run your businesses, it was how I ran mine originally. It is calculating your sales minus expenses, and whatever is left over is what you happen to take home in profit. And sometimes there might not be any, right? Profit First encourages business owners to flip this and calculate what they can afford to spend in expenses based on their sales minus the profit that we want to be generating. So, for example, if I make $100,000 a year in top line revenue and I know I want $5,000 left over at the end of the year in cold hard profit to either take as a distribution or distribute to investors, however you have your business set up, well, then you have $95,000 for that year to allocate to your other accounts, right? So companies often fail because they focus solely on growth, especially startups, and they invest too much in only generating more and more revenue without an eye on the profitability, which is really all that matters. And it like really boggles my mind. So my partner works for a multi-million dollar, possibly even billion-dollar company. And my businesses actually take home more profit than these multi-million dollar businesses because I focus on profit, not just growth, right? Of course, I focus on growth as well. All right. So most business owners do what is called bank balance accounting. So when they want to know how much money they have and what they can spend on something, for example, a new vehicle, repairs, hiring a new salesperson, right? They log into their bank account and they see what their balance is. All right, you have one bank account, you've got $100,000 in there. Great, I have $100,000. Then they make decisions based on what they think they can afford based on that number. But that number doesn't tell the full story or factor in money that's already should be earmarked for taxes or your own take home pay or ongoing expenses like software or insurance or all of that. So if you make business decisions based on your bank balance, you can go out of business very, very quickly because you don't actually have a clear picture of how much money you really truly do have. Because no matter what, the government owns probably a third of your money, regardless of whether we want it to or not. Okay, so there are 5 types in the Profit First method. There are 5 types of accounts that you are going to want to set up. I do my banking with Chase. It can be whatever, bank you want to work with. But there's 5 accounts that you are going to want to set up. The first one is an income account, then profit, owner's compensation, operational expenses, and taxes. All right. I love I've loved banking with Chase. I've been banking with them for over 20 years, but I like that when I go online, I can set up nicknames for the accounts, easily keep track of everything. I can even group them by business. So I can have 5 accounts under one business. It just makes it logistically very easy, especially since I have so many businesses. So let's talk about each one of these accounts in a little bit more detail. The income account, this should be a checking account. This is where all of your revenue flows into. So no matter if you're using Stripe or Square or Venmo, PayPal, whatever you're taking money through, all of that needs to get deposited into a singular bank account, which will be labeled your income account. This is the account when for example, I log into Chase every Monday, did it this morning. I see, I have $12,000 in my income account. All right, I'm going to take that and now distribute that into my other 4 bank accounts based on these predetermined calculations that we're going to go over. And at the end of the day on Monday, my income count has $0. And then it fills up again over the week until I do it again next Monday. Okay. Then there's the profit account. Now, this can be a checking or a savings account. I recommend using a savings account, preferably a high yield savings account with a different bank account than your primary accounts. So, profit is something you're not going to touch, right? You'll either touch at the end of the year or possibly quarterly after you do your estimated taxes. But the goal is you're not touching this. You're not dipping into this for any sort of expenses or for your own personal expenses. It is sort of a sacred account that you don't touch. And if you're setting it aside in a high yield saving account, then over the several months that it's kind of sitting there before you do anything with it, it's earning money on, earning interest, right? So I don't know what the rates are right now, but when I first started, I think it was like 4 or 5% high yield interest. And that money is just sitting there earning more money every single quarter. So that's one account. Then there's owner's compensation. This should be a checking account. This is where you're going to transfer money that is earmarked for your own compensation based on these percentage calculations that we're going to go over. So, for example, every Monday I put roughly, depending on the business, 20-25% of the money that was in my income account into my owner's comp. And then for me, my owner's compensation accounts are typically much higher than what I need in any given week. So I let them continue to kind of fill up and grow. I have maybe 3 to 6 months worth of padding in that account. So if I have a bad week or if I have a bad month, even a bad quarter, I'm not freaking out because I have money in that owner's comp account. And then every single week, I just take out what I know I need. And every single week, let's say it's $1,000 every single week from one of my businesses. Then I take that out, even if there's $12,000 in the account, right? I just don't touch the rest of it. So there's your owner's compensation account. Then there's operational expenses. Again, this should be a checking account where you'll transfer money earmarked for your operational expenses. This could be things like contractor payroll, software, marketing and advertising, insurance payments, car payments, all of that. That would all be under the operational expenses. And then there's taxes. There's no way around it. You got to save money for taxes. I like to put this in a savings account, again, a high yield savings account, because often it's a considerable amount of money. So I would rather have $30,000, $50,000, $75,000 sitting in a high yield savings account earning 4 or 5% than sitting in a checking account earning nothing. So that means the money that's going to the government at the end of, if it's June, July, August, whatever, at the end in September, I've already made a couple $100 to a couple $1,000 off of that just sitting in a high yield interest account. Okay. Just for reference, if anyone is curious, my high yield savings accounts are with a bank called Marcus Fund. Do your research. I don't know if they have the best rates at this point, but they had the best rates several years ago when I was setting all of this up. Okay, here's a quick tip that actually was incredibly valuable for me as a business owner. I learned this at a mastermind I went to with, multi-million dollar businesses. Never, ever, ever pay expenses from first of all, you should never pay expenses from your checking accounts, right? You should put them on a credit card. Now look, speak to an accountant, right? I'm not an accountant. This is how I operate my business. I never pay expenses out of my checking account. I put them on a credit card, ideally a credit card that has really good points associated to it. And sometimes, depending on how you're spending, like I spend a lot on advertising, and I know that Amex does, I think it's like 3 to 1 points on ad spend. So I'm going to put all of my ad spend with Meta, for example, on that credit card because I'm going to get way more credit card points, which I can then redeem for cash back or travel or whatever down the road. So first off, put expenses on credit cards and then pay them off. Then let me just see here also. Can you guys hear me? Can you pop in the chat that you can hear me? Okay, great. Okay. I just saw that you couldn't hear me in the chat just now. I was like, oh no. Okay, so back to the expenses. I recommend putting expenses on a credit card, and then ideally you can pay it off every single week in full so you don't carry a huge balance, right? But you're accumulating credit card points. Then what I do, you should never, when I first started in business, I used to pay off my credit card, my business credit cards with my business points. So I would do basically like cash back and then pay off my business credit card. That is not what you should do. You should only use your business credit card points for personal use. So, for example, let's say I had $2,000 worth of cash back on my credit card. If I use that to pay off $2,000 of expenses on my credit card, fine. But if I use it cash back for me personally, so I take that $2,000 and put it in my personal account, well, at the end of every month, at the end of every week, I'm usually only taking home 20% of whatever my gross revenue is, right? So that $2,000 that just went into my pocket is actually really worth $10,000 worth of revenue. So it's worth a lot more to you if you take it home as a personal benefit versus a business benefit. So, I just booked a trip to Curacao for my whole family, all-inclusive resort. I'm so excited last week of August. All on credit card points just because, I've been spending money on ads. So it's an amazing, amazing benefit. And it makes spending money on expenses feel a little bit easier, right? So pay for expenses on credit cards and then use those points for personal use. Okay. Let's talk about assessing the health of your business with this method. So, like I said, this is a cash management system that is based on actuals, not accruals. So, before you start this assessment that we're going to go through, you're going to want to get your P&L from your last full year in business, so 2024, from your accountant, your bookkeeper, whatever. If you don't have a P&L, then you should get one. But you can work from projections, like if you have a new business. But if you don't already use some sort of accounting software, such as QuickBooks, you have to start using something like that right away. Okay, so here's what we're going to do. You have your P&L, so you know exactly for the year of 2024 how much money you made. You're going to put that, your top line revenue, in this column here, top line revenue actual for the year prior. Materials and subs. Most of us can ignore this and you won't put anything here, but let's say you are operating a farm out only business, right? So 75, 80% of your top line revenue is going directly out to your affiliates. Then you're going to want to put that here, right? So let's say you made 100K, 80,000 of it went right out the door to your contractors, whatever, put that there. Otherwise, most of us can just do top line revenue is the same as the real revenue. Okay. So then, depending on how you just did the last step, you're going to put your real revenue there. So that's either just whatever your top line revenue is or top line revenue minus the materials and subcontractors. So you have your real revenue number. Next, you're going to look at your P&L and say for 2024, what did I actually take home in profit? What was that actual number? And it might not be anything, right? It might be a big number. I don't know. Then the same thing for owner's pay. How much did you personally pocket in 2024? How much did you pay in taxes? That's state taxes plus federal taxes. And then what did you spend in operating expenses? Again, this could be rent if you have a space. It could be fleet costs, leasing cars, buying cars, maintenance, all of that, right? Your insurance, application fees, labor fees, right? So if you have drivers who work with you, but it's not necessarily like 80% of your business is farmed out, then I would put those staff payments here under operational expenses. Okay. Next, we're going to calculate the remaining columns using a new figure that shows the target allocation percentages based on real revenue ranges. So let me break that down. That sounds confusing. So here's all the different columns we want. We want our real revenue, which now we know real revenue is 100%. That's the 100% number. Then you have your profit, owner's pay, tax, operational expenses, which we've already put in there for 2024. We know what those are. This figure shows you typically based on how much real revenue you are making, ranging from $0 to $50 million, how much you should be allocating as a healthy business, as an ideal healthy business to each of these different accounts. So let's say you're making under $250,000. Well, let's say you made $100,000. Your real revenue is $100,000. You want 5% of that going to profit, 50% going to owner's pay, 15 to taxes, and 30 to operational expenses. That is considered a healthy business. And again, this is according to Mike Michalowicz's whole method here. If you're making more, typically when you have more revenue, well, then, your owner's pay is not going to be 50%, it might be 20%, right? Operating expenses probably get higher because the bigger business you have, you probably need more labor, you have more costs, et cetera. There's cost to scale, right? So take a look at this. And again, there's going to be a recording, but get a sense based on how much money you made the previous year of roughly how much you should, in ideal scenario, be allocating. So next, we're going to just plunk out the actual numbers. So this is a hypothetical business, made $283,000 in top line revenue. We didn't calculate anything for materials and subs. So they made $283,000 in real revenue. They only did $7,000 in profit. They paid the owner $78,000. They set aside paid $21,000 in taxes, and operating expenses were $177,000. Those are their real actual numbers from the P&L. Now, in this next column, the PF percentage, profit first percentage, that's what our ideal number should be. So, as a business making over $250,000, they'd be in column B. So they should be saving, in theory, 10% for profit, 35% for owner's pay, 15% for taxes, and 40% for operational expenses. And that should, on $283,000, equal $28,000 in profit, $99,000 in owner's pay, $42,000 in taxes, and $113,000 in operational expenses. The bleed is the difference between what the actual was and what the ideal should be. So for example, they only got $7,000 in profit, but we wanted them to be at $28,000. So there's a delta of $21,000 there, right? Owner's pay, same thing, $21,000 delta. Taxes, they actually paid $21,000 less than they probably should have, or allocated less. And then operating expenses, they are over budget by about $64,000. Again, based on a healthy ideal business making a certain range of money. Now, we talk about what the fix is here. So for profit, we need to increase the profit. We need to be doing better than $7,000 at the end of the year. Owner's pay, we need to increase that. You deserve to be taking home as much money as you possibly can for all your hard work. Same thing with taxes. All right, you probably didn't save enough for the government, right? They need to get theirs, whether we like it or not. Operating expenses, you're overpaying somewhere, right? You're spending way too much money to operate your business, whether that's in advertising spend that's being wasted, or maybe some extra staff members that you could combine, or maybe you could outsource something in a different way. There's ways to decrease expenses, right? And I'm not saying go through and cut, 20% of expenses in one day, but that's the point of this, is to start seeing, all right, where are the areas that I should make some improvements here? And how can we do that slowly and measurably so we're not just like completely rocking the boat here? Okay. So current allocation percentages, that's where we look at this in percentages. So we're actually only right now, the CAP is 2.4%. So 7,000 out of 283,000. We only saved 2.4% in profit. We did 27.5% in owner's pay, 7.5% in taxes, which is way too little, and then 62.5% in operating expenses. So those are our current day one current allocation percentages, CAP. So that's what we're going to work with when implementing this profit first method from day one. We know where we want to be, 10, 35, 15, 40, and we see where we are. All right. So now we're going to implement the profit first. We have set up our accounts. We have an income account, a profit account, owner's compensation, tax, and operating expenses. When I set these up and I do the nicknames, I like to also include the percentages in the name of the account. So it's really easy for me to remember. So here it's named income, it's just income. It's whatever's coming in. Profit, 2% is where we're at now. TAP is I forget what it stands for, but the what we want it to be, right? So that's 10%. Owner's comp 27, TAP is 35, tax 7.5, TAP is 15, OPEX 63, TAP is 40. All right. And then those are just fake account numbers, right? So that's what your accounts would look like in Chase or wherever you bank. Now, day one, we're going to want to adjust these just by 1%. Surely 1% isn't going to make you go out of business. It's not going to rock the boat too much. So profit's going to go up to 3% instead of 2. Owner's comp going to go up to 28. Taxes 8%. Operation expenses, so an expense is going to go down from 62 to 61%. So we're getting 1% closer to our goals here of a really healthy business, right? So let's say on Monday I log in and I had $1,000 in my income account. I'm going to put 30 into profit, 280 into owner's comp, 80 into taxes, and then actually 610, typo, 610 into operational expenses, right? So we're not just suddenly putting 400 in operations and 150 into taxes because that's not the way our business is running right now, right? That's the goal, but not the reality. So the next step of this is to cut your expenses. What I do, something quick tip in here, I love to do something called an efficiency challenge with my team. Now, if you're a solopreneur, you can even just do this for yourself. But I like to say, all right, team, I have about 8 people that work for me. I'm going to say, I want you to each of you come up with at least one, but you can submit more than one idea on how we can either cut expenses, so save money, or improve efficiency, so get more done with less time. Go. And my team submits all these great ideas to me. It gives everyone a sense of agency, like, ooh, I could, like I could actually make a difference here. And I say the best idea wins $100 or $200 or whatever, right? So you give them an incentive. And now I have at least 8 ways to cut expenses or save time that are surely going to make me way more than $100 that I just paid my very happy staff member, right? So if you work for yourself or if you don't want to do that, then definitely look at your expenses either on your P&L, or I literally will look at my credit card statements because, again, all of my expenses are going on a credit card, not my account. I export the 12 months of my statements and I highlight every expense that either could be just completely cut, or like one great way to do it is, first thing is I always look at the recurring expenses, things like rent or subscriptions, training classes, magazine subscriptions, whatever. And I say, all right, are any of these things that we don't use or it doesn't make sense anymore? Let's just cut those, right? The next thing is, a lot of times if there is a subscription that we use, like let's say I have a marketing tool that is essential to my business. Well, then I'll say, great, how can I save money on that? Oftentimes it's going from monthly to a quarterly or an annual plan. So you might get hit with, instead of $200 a month, it's only, it's a $2,000 upfront payment, but I'm basically saving $400 or $500 for the year that I know I'm going to use this for the full year regardless. So I'm saving money and I put it on a credit card. I get the points for it, right? So see how you can cut expenses. And then obviously not just recurring expenses. You're going to look and say like, did we really need to buy that? Do we really need to buy that in the future? How can we save money moving forward? All right. Then implementing the system, you're going to want to set your distribution schedule. For me, like I said, it's every Monday. For you, maybe it's every other Tuesday. Maybe it's last Friday of the month. It can really be whatever you want it to be. I find it really helpful to keep an eye on my financials on a weekly basis. It's how I pay myself. I pay myself every single week. So that's how I like to do it. Then you want to do your profit distributions. So for me, I do it at the end of every quarter, every financial quarter. Once I have my accountant tell me, here's how much you actually need to pay the government, state taxes, federal taxes, assuming I don't have to dip into any profit accounts, which typically I don't, then I take that money from my profit account and I put it into my own personal high yield savings. So that becomes what's considered a distribution. So that's owner income, right? I take that money. You might decide, all right, I'm going to take that profit and I'm actually going to reinvest it in my business. And I am going to buy that $2,000 subscription, or I am going to invest it in coaching or a new Cadillac or whatever, right? So, but it's your choice. That profit is there to give you options, right? You could also do it once a year. You could save all your profit up in your high yield savings account, and then at the end of the year, figure out how you want to distribute it. Maybe you take some personally, maybe you reinvest some in the business. And that's it. Now you know how to set up and implement the profit first method. Hopefully, I've given you some ideas on how to better understand your financial situation, make it easier for you to see, and also ways to start reaching your financial goals, even if it's just 1% at a time, right? Maybe you only adjust that 1% once a quarter. Or, probably you're probably not doing it weekly, right? Your business probably isn't changing that rapidly, but you might see, oh, actually, I was able to cut 5% from my operational expenses. So, okay, let me take 5% off of that allocation and put 3% into the profit account and 2% into my owner income account, right? So that's how you start adjusting the percentages to get closer to your actual desired percentages for your business.